Hello students, welcome back. This is Mrs. Bloomquist. We are all the way moved through to Chapter 8, which Chapter 8 deals with recording closing entries and then preparing a post-closing trial balance for a service business. So we're going to continue to look at Delgado Web Services, and for the first lesson in Chapter 8, we're going to be just recording the closing entries. So our objective is to journalize and post closing entries for a service business that's organized as a proprietorship. Now, one of the things that you want to remember is that we need to be keeping track of sales and expenses over a specific period of time, and then also think about anytime we ever hear about people doing accounting for a business, that they frequently use the term closing the books. And so what we are essentially doing here is we're going to be closing out some book information for the fiscal time period that we're dealing with. And in fact, we will do some closing out at the end of every fiscal period. So one of the things that we need to know as we move forward is that we have some accounts that are called permanent accounts, and then we also have some temporary accounts. Okay, so accounts that are used to accumulate information that we need the information from one fiscal period to the next, those are permanent accounts. They're referred to as the real accounts, and those accounts don't go anywhere. But there are also some accounts that we use to accumulate information until we put it in the owner's capital account, until we're starting to look at something as owner's equity. And these are called temporary accounts. And occasionally we also refer to these as nominal accounts. Now, you just want to remember that these temporary accounts, these show changes in owner's equity and capital for a single fiscal time period. So at the end of a time period, we always summarize and transfer that information to the owner's capital account. So all temporary accounts begin a new fiscal period with a zero balance. Journal entries that are used to prepare temporary accounts for the new fiscal period then are called closing entries. So these temporary accounts have to go down to zero at the end of a fiscal period. So whatever we do to them, we post some closing entries to take them back to zero so that at the beginning of the next period, they're at zero before we start. Now, there's also an income summary account. And whenever revenue, so money coming into the business, is greater than the total expenses for the time period, this means we have net income. And the net income summary account is what we use then to transfer the money that we know has come into the business into the owner's capital account. So as we look at this income summary account, we can see, using this T account, that revenue in this case is greater than expenses, so we have a credit balance in the income summary account. So income summary has a credit balance. When the total expenses for a business are greater than revenue, which means we didn't make money, we have a net loss, then when we look at that income summary account, the debit balance shows a net loss. So if it's a credit balance in income summary, we have a net income. And if the debit balance is showing in the income summary, then we have a net loss. So whenever you're looking at a closing entry for an income statement account that has a credit balance, so remember, we're on the income statement accounts and they have a credit balance, then what we're going to go ahead and show in our general journal is a closing entry so that we can go ahead and post a debit to sales as a closing entry, and you can see it right here on the left side of our T account. Then in our general journal, when we have a closing entry, we are going to debit sales, and now we have our income summary account that has a credit balance. So now let's look at what we do when we're writing a closing entry for an income statement account that has a debit balance. Okay, so here's the income statement, and it shows that we have lots of accounts with a debit balance on our income statement. See, we're looking at our income statement. So we're going to total these up, and we're going to go ahead and post a credit to all of those accounts in our closing entries, and then we are going to post a debit to our income summary account. So this is our income summary. That's the total amount we're going to debit, and we total up all of the credits so that we can close this out. Okay, if you wanted to go ahead and look at all of the T accounts associated with the entries that are right here on the income statement accounts with debit balances, all of those T accounts where we're noting what the closing credit amounts would be, they're all on page 219. So if you want to kind of reference right in your book and look at what you're seeing, they're all listed on page 219 in your book. Now, when we're looking at what's going on the closing entries that we would use to record the net income or a net loss, and then actually close the income summary account. So what we're looking at here is that we have a debit of $26.58, and then we have that credit of $58.20. So then we have our net income amount, which is $31.62. We also, in our income summary account, are going to have a closing entry there of $31.62, and when we close out our income summary account, we're going to go ahead and put that in the capital account because now we are characterizing that income as owner's equity. So you can see we would date at the end of the month. It is the income summary account. It is net income when we're looking at our income statement, and in our general journal, we're remembering that we're closing out that income summary account so that we can put this income in our capital account. Okay. Now, we might also need to do a closing entry for the owner's drawing account. And remember that the drawing account is what we use to pull money out of the business as a withdrawal. So whenever we have that situation going on, you can see that the drawing account needs a credit to close it, and then we post that credit. We post that credit, and then we're looking at the change to the capital account and the drawing account. Okay. Now, again, if you wanted to go and look at the effect on any of the specific T accounts, you would look on page 221 if you were looking at that closing entry for the owner's drawing account. All right, so questions. What do the ending balances of the permanent accounts for one fiscal period represent at the beginning of the next fiscal period? They are the beginning balances. It just carries over. What do the balances of temporary accounts show? And remember what it is we need to do with all temporary accounts at the end of the fiscal cycle. So changes to the owner's capital account for a single fiscal period. So the balances in the temporary accounts are what we use to figure out what's going on with the owner's capital. For closing entries, this is a really important one. First, you need an entry to close the income statement accounts with credit balances. Then you need an entry to close the income statement accounts with debit balances. Third, you need an entry to record net income or net loss and close the income summary account. finally, you need an entry to close the owner's drawing account. That's it. All right, so right here you want to head on out to Aplia to do the work together and on your own. And after you complete both of those, you should move forward and start doing the applications for 8-1.